We're talking about the bridge collapse.
The bridge
She was
collapse.
close to that.
Yeah. I mean, I was on it the night before.
Oh, my goodness.
Our
My
friends
nephew,
tried-
and they do the trail underneath, right, the bridge.
Sarah might know.
Did they figure out what caused it?
Well, no, but I think there's a couple things. One is there was too much weight going over there. The bus was overweight, and you think about how many buses go on there every day. So that was an issue. And then structurally underneath, I mean, I bet it was structural. I mean, nobody died.
Yeah.
Thank God. If it was an hour after that, it would have been a nightmare. So, no, I haven't. But it's just the strangest thing because I drive it almost every day. And I go like this, and I'm like, nope, I have to go straight. And it's really kind of changed the dynamic of traffic, but it wasn't too bad today. It was nice. I got the park line. I was like,
Okay. Wow.
All right, everybody ready?
Yes.
Let's do a little call to order this February 15th, 2022 meeting of Lawrence County Retirement Board. Roll please rise for the pledge of allegiance, followed by a brief moment of silence. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Now please remain standing for a brief moment of silence. Thank you. Vanessa, please call the roll.
Controller Prestonheim,
Here.
Treasurer Rapone,
Present.
Commissioner Spielvogel,
Here,
Commissioner Vogler,
Here.
Commissioner Boyd.
Here. We have a quorum. Any public comments today? Hearing none, we have approval of the minutes from November 16th, 2021, which was our last retirement board meeting. I'll give my colleagues a minute to check those over, and I'll take a motion to approve the minutes or make any changes as necessary and expedient.
I'll move for their approval.
Second.
Motion Vogler, second Rapone. Any further discussion? Hearing none, question on the motion. All in favor, please signify by saying aye.
Aye.
All opposed, same sign. Motion carries. Sarah, how's the fun doing?
good morning.
Thank
Well,
you.
good morning.
Let's talk a little bit about what we did last year. Just so you know, that's what the actuary is going to see, that's through your ABC, so it's not good. I also included, we've got kind of the Pennsylvania County database report if we want to go through that. But let's talk a little bit about this. If not, we've done this a couple times, just read through it at your leisure. So if we go to Exhibit 1, I just want to give you a little bit update about Marquette. Actually, our Westchester office, which actually does a lot of the servicing of you, added there. We've added 3 new client analysts, performance analysts, and Kat Armstrong started last month. She's out of Chicago, but she will be working with me as my client analyst on your account. And you just see we have 99% client retention rate, and currently we're $332 billion under advisement. So when you look at COVID and everything, our industry actually came through, which was, it was nice. And then we just added 2 new female full-time partners. If you go to Exhibit 2, let's talk a little bit about the market. Of course, it's a little bit different than what it was now. But we look at the fourth quarter economic accelerated in the fourth quarter with real GDP increasing better than expected annual rate of 6.9. And you can look at that graph, look at year over year, and then you go all the way, you look at the yellow, and then look at the blue for the fourth quarter, and then we can see that we're expecting that's going to start going down there. For 2022, a continued increase in inventory investment is expected to be a key driver of economic growth as inventories remain near historic lows, and we really have seen that. Especially, you look at the car industry. Usually, the car industry, when interest rates are low, people are out buying cars. It's 4 years to get a Toyota 4Runner right now, if not on the lot, if you want to build it or something. So we're starting to see that, and that does have a lot of effect to that. The U.S. economy is grappling with persistent supply chain distributions. Outside, several countries are reimposing lockdown measures. Most notably was China. We know that they've lifted some of that after a strong 2020. China lost 20.7 due to largely to regulatory changes, default concerns, and policy shift from all-out growth to sustainable growth. Common prosperity. So China's been really struggling. We look at the U.S. retail inventory to sales ratio. that chart below, look at the difference in the change versus retail versus inventory. Most economies expect inflation to peak in first quarter. We know that happened. We've seen that in the last, CPI came out, and we know inflation is going as long as we expect that the Fed's going to raise 0.50. And then we think there's going to be 3 or 4 more interest rates. And it's interesting, if you look below on page 10, you can sit there and say, look where the future markets are, and then look where the Fed 2021 projection. So what's that saying? Is Fed saying we're going to keep raising rates? The market says, oh, I don't know if if they're necessarily going to do that. That has been inverted. Every time we've looked at this graph in the last 2 years, future markets have been saying they're going to raise it, and the Fed's like, no, we're not as much. So it's really kind of turned on where the market looks at that. A tight labor market coupled with accelerating inflation across most industry has led the Fed Reserve to shift its outlook for monetary policy. And this is interesting. Notably, the quit rate or resignations as a percentage of the workforce within private industries, it continues to increase. A record number of workers quit their jobs in November, seeking better opportunities, higher wages, or leaving the workforce entirely. So, we've really seen, I think, that Pittsburgh, communities, maybe your county, I know a lot of our other counties, is that people just are not being able to be employees. I mean, go look at the restaurant industry has been crushed by that. And a lot of that has been that people got used to working from home, maybe one income, or not going back full time. So we're going to really start seeing that having an effect on the economy. If you turn the page, outside the U.S., similar dynamics are playing out across the global economy. Global economic growth appears to have re-accelerated meaningfully from the third quarter slowdown. We really did see some economic slowdown outside the U.S. When we had looked at third quarter performance, we saw that international companies had really struggled there. And then one key expectation is, we look at where the Omicron virus, we had this big peak, it's kind of going down. China still has the zero COVID policy, a challenging property market, and subdued credit growth. So China's really kind of had a little bit of struggling there. And then we look at the central banks raising interest rates, and you can see the emerging markets are really starting to raise in the fourth quarter. Non-U.S. developed markets outperform emerging markets with positive earnings surprises and improvement sentiment. So we will see that when we look at your performance. And then let's go look down below at what's been happening with the equities. U.S. equities for the year did 25.7. Didn't expect to see that. For the fourth quarter, 9.3. You can look though, international bonds and U.S. bonds have really struggled. Last year, they were in negative territory, 1.5 negative, and then they were flat for the quarter. Fixed income returns were muted. Sub-investment grade debt outperformed with high yield bonds and bank loans returning 0.7. Remember, we made that decision in 2020, and about March, April, we put you into some exposure to high yield, and that has helped the portfolio a bit. And then large cap equities outperformed their smaller peers in both December and the fourth quarter, while style leadership depended on market capitalization. So growth stocks led their value counterparts within the large cap space during the quarter, while the reverse was true. Mid and small cap value outperformed growth. So you're going to see, and when we see a volatile market, we know that we tend to see value outperform growth. And you're going to see that with the update on the performance. We take a slight value tilt, and that is always, down when the market's down. That has helped you there. You look at U.S. REITs, 16.2% for the quarter, year to date, 41.3%. We'll look at your real estate. One of the things that has changed, especially when we look at the private real estate, is that 5, 6, 7 years ago, they were doing high-rise apartment buildings, they were doing business developing cities and stuff, they have really looked at now, putting and diversifying into storage. Storage units has become like the number one holder across the United States, because everybody needs storage.
Or their
Really
stuff.
store their stuff, and that has become a part of the portfolios. If you turn the page, you can look on page 13, excuse me, look what energy did. 56.5% for the year. You look at consumer staples, consumer discretionary was at 21.8. And we look at utilities, we're at 17.5. And then at that bottom, we look at the profitless tech versus the mega cap tech. And you can see the 5 largest stocks and where it goes. And what it means is the 5 largest stocks are Microsoft, Apple, Amazon, Telsa, and Alphabet. That changed a little bit. We saw Google in 2020, those 5 stocks we talked about, controlled the market on the way down and then on the way back. They were the 5 stocks moving the S&P 500, 495 were kind of flat there. So we look at that, and when you look at the rallies and the ups and downs, Facebook, look how much Facebook lost in the last 2 to 3 weeks. And that's why be very well diversified, which you are. So there, and we look at fixed income down there, look at the high yield spread. You can see that, look at January 08, you see where that really became a lot, close to almost 2 basis points. And then you go look where it peaked again, and that is where it peaked when we got you in April and May of 2020. Are there any questions so far? Okay, let's talk a little bit about how you've done. So, you hit your all-time high at 104.1 million for 12/31. A little bit of a different story there. And actually, you had a gain, and I don't know why that says it was lost, and I apologize, I will do that. You had a gain for fourth quarter. You returned 5.6 versus 5.5. You had a 2021 gain of 13.8 million. And then for the year, you returned 12.3 versus your policy index of 11.4. So you really had some outperformance there. Large part of that is when you start seeing a real volatile market that happened in the last 6 months, you had some real defensive managers in there that helped. U.S. equity structure helped, outperformance by active non-U.S. equity managers, value overweight within the U.S. small cap, so that helped too. And then fixed income structure, we'll look a little bit about that. Underperformance by most active global equity managers, and that has kind of changed when we go look at this quarter. Your global equity managers, usually in an up market, struggle a little bit. In a down market, they usually outperform. And then emerging markets overweight within the non-U.S. equities, and we have looked at that and have done some trading. We funded the TA Realty Core Property Fund, and we split the defensive equity piece that we put you into and added parametric defensive equity. And the reason why is that you had so much in there, we just kind of wanted 2 managers within there for more diversification. We know that a JP Morgan Infrastructure Investment Fund expected to call the capital in 4 to 6 quarters, so you're in the trench for that.
Sarah, remind me, we made a policy transition last year. Was it to get into infrastructure?
Yes.
I just want to compliment you and Markel on your foresight in that. That happened before all the federal infrastructure dollars and the federal infrastructure bills came down. That was a well-informed, well-calculated bet that is going to pay dividends, I think. So I just appreciate you and your company having that foresight.
And it makes sense, once you get to a certain point, size, you want to keep diversifying. And look at fixed income. You're getting nothing from fixed income. So we'll go look at how those managers did compared to, with that diversification in the last couple of years, how that's helped there. And, since inception, you've annualized, since we've been here since 2014, you have had a net investment change of 54.8 million, and you've annualized 9.1% per year.
If I'm reading that correctly, since you folks came in 14, the value has almost doubled.
Till the close of business.
Okay.
Yes, for
December
12,
31.
yes, you have doubled.
Yeah.
It has really doubled, and you've actually had, and in the last 3 years, you think about this pandemic where we were coming off the market, you actually returned in 3 years 15.2% annualized and made 37.6 million. And I think that's a really good look at how all of those changes that you've made in your investment policy and how that's really helped you. Because if you were just 50% equities or 60% equities, 40% fixed income, you would have never gotten to that. So, I do commend the board and, taking our guidance and really kind of diversifying this portfolio. You've done very well. Let's look at very quickly, let's talk a little bit about your managers, and we can look at the performance. So your total fund, and that's page 26, you did 5.6 versus 5.5. Your total equity composite did 7.5 versus 7.2, and then for the year it did 21.4 versus 20.9. And you did have some outperformance by your US equity composite, and that would be look at your Eaton Vance SMID. And a lot of that was they had some very good stock picks within the portfolio. They did 9.7 versus 3.8 for the quarter. In 1 year, they've done 22.3 versus 18.2. And then we have, the Fidelity and the Vanguard Small Cap Value Index, which we put in July of 2020, and that has done 43.5%. And then we just, we always talk about this. We would love to see an active manager. We always try and put one in the US equity to go out and find another active manager that's going to do better than the index for what the cost. We just don't see that right now in the domestic equities. We feel that your active management is better in the global and your international. And you can see your global actually struggled. We talked a little bit about that. It's come back last month. And we expect that, but MFS low volatility did 6.7 versus 6.3, and you can see that at the bottom. And then 18% versus 3.9. And in August 2021, we put in Artisan Global Opportunities. We're very comfortable with them. They struggled a little bit for the quarter, but long term, we really, really like them. I mean, you can't just look at something for a quarter. If you turn the page, we'll look at your non-US equities. So Hartford Schroders did well, 3.0 versus 1.2. And then in February, we actually did the Fidelity Total International Fund Index and the Fidelity Emerging Market Index, just to kind of put in some more diversification. And then real estate. This is what I think is interesting when you look at the portfolio. Remember, we took real estate. You funded real estate with 50% fixed income and about 50% equities. Real estate for the year did 21.4% for you, and fixed income was negative 1.6. So that really added a nice growth. They did for the quarter 7.8, and you can see they've annualized since March 2016, 7.6%. And we said 5 to 7 annualized, 5-10 years. It's great. So that's a nice diversification there. We did put you in October 2021. We put you in the TA Realty Core Property Fund that did 8.3 versus 7.7. So we just wanted to have some more diversification and have 2 different types of manager in there. So you had more diversification over the whole real estate market. And then defensive equity, we put you in that in August of 2021. And you can see that did 5.5%. Remember, that is from fixed income and from equities there. And US fixed income it's had a hard, tough year. We look at that, and you have you in the Fidelity US Bond Index and Vanguard Aggregate Bond Index. One of the things I think I'd like to do is put you in an active fixed income manager going forward. So that's something that we have discussion, but, I think it's probably time it's ready to do that. We have you in 2 indexes, and I think, so we're gonna start looking at, and probably it's gonna be a local, maybe Pennsylvania, they do a lot of county work, bring you into that kind of, maybe half of where your fixed income is.
Sarah, that 3 months, 7.8 and 5.5, is that an annualized or is that over a 3-month period?
The 7.8 for real estate,
It's both 7.8 and 5.5. Is that an increase over 3 months or is that an
that's
annualized?
your increase, and then 1 year you did 21.4, and then for annualized every year, you've done 7.6 since you put it in.
All right, so in other words, just to clarify, we've gotten a 7.8% increase over just the last 3 months
Correct,
and a 5.5 increase in last, that's
which is
good
great.
job.
And so remember last year though, we have to point out 2020, they struggled. So you're gonna have that up and down. We look at, it's great to have a 21% year, and we know that it's gonna happen every once in a while. As long as it does, between that 5 and 7, it's doing what we wanted it to do, and it has been doing very well. Before I look at this, I just kind of want to talk a little bit. We always say where the market's going. Do you have any questions about the fourth quarter?
I do.
Okay.
I don't know if it's about the fourth quarter. Now the time asking question.
Ask a question, Rich.
Okay, all right. First of all, I'm very encouraged through the 2 years of COVID, how well the county has done. So thank you for your management through all that. So I think that's incredible. I really do. The current market value, what is it?
Let's pull this out.
Okay.
I want to talk about that.
Okay.
You're at 99.3 million. So you have taken, for the month of January, you were down 3.4% versus the benchmark of 4.1. So you did 70 basis points over the benchmark, and that's exactly where we want you to be in this portfolio. It's protection in the down market. So you did lose some, but 99.3 is still, you're still ahead there.
And for clarification there, I mean, the market sometimes experiences downturns. And as a result, the fund sometimes experiences downturns. And in the grand scheme of things, a 3.4% drop, the fund is still 100% funded and very stable.
Right, yes. And let's just look at this a little bit, because the amount of volatility it had, we look at your total equity composite was down 4.2%, total equity policy index was down 5.4%. So you outperformed by 1.2% there. And we talk about global, and I want to say that, we looked at the global. Your global managers in an up market possibly won't do as well, but in a down market, they will do very well. And that is kind of protecting you, because look at, they did -3 versus a -4.9. So it's 1.9, 190 basis points ahead of the market. And we looked at AB Global, which we put into -2.7 versus -4.9. And then look at your non-US equity, your Hartford Schroeder multi-cap value, and we said that's where we're going to start seeing value. They did 0.4, so they were actually positive in a down market. And then we didn't get the real estate, because the real estate takes some time to come in there. And then US fixed income is right on the composite of -2.2. And I think that's really where we're going to start looking at getting an active manager. I just want to say, one of the things when we look at the theme for next year, what's going to happen for 2022, and we came out, the S&P 500 returned 31.5, 18.4, and 2.87 respectively over the last 3 years. That's a cumulative return of 100%. When we look at it by the low rates, Fed stimulus, and overall risk on sentiment, in spite of global pandemic for the last 2 years, the U.S. equity market actually grew. So we look at the 2021 equity returns were driven by earnings growth, which provide material support for equity prices because companies are profitable, versus the 2020 returns, which were driven by multi-expansion and are less sustainable over the long term to support equity prices. So it's growth, and we think that that's good news, and the earnings are expected to remain positive in 2022. The bad news is they will grow more slowly from this point forward. Because, we had a shutdown, everything shut down, then, industries were shut down, and then they came back, and then they went back a little bit. So they had a lot of growth last year. We know it's gonna cap off, but, we still think is that, positively, you can't stand back and say it's gonna be a negative year. We don't know. We know that there's some political issues. I mean, the market kind of opened a little bit happier that Russia was kind of easing back on the basis. I mean, we've got a lot of political things. We need inventory to come back up. Obviously, you're starting to see the mask mandates ending, this COVID. Hopefully, we've gone through that next, sway of things. But we do believe that taking a value tilt is going to be a little better. We're going to see value in the small and mid cap for 2022. We know fixed income is still going to struggle a little bit, but with the rates going up, you have a lot of managers who've sat for the last 5-6 years just waiting for those rates to go up and cash. So we'll start seeing them go in and start buying some fixed income. Are there any questions?
You have a question, inquisitive.
I do.
He has a question.
So,
Just the look on your toes, like you were waiting for your moment.
that's okay. So we used to get like sometimes weekly, bi-weekly reports and everything. Did they stop doing that? Or?
No, we should probably get Cax now back on the team. We did
Okay.
have a lot of this, there was some personnel thought they were getting done, they weren't, so we'll start back, I'll
Okay.
start back
Thank
on those, because they usually just do that, so you'll see those weekly starting.
And one more question. Where does Lawrence County fare in regards to?
Back to the book, back to the
Now, let's
Bible.
go to the white book.
I'll be right back. Please continue, Rich, you're in charge.
How much
Oh, no,
time do you have?
As much as you need.
Okay, so
That's right.
let's do the report, because I think this is always a nice way to look at it.
I mean, unless you, no, yeah, we're good.
I'm
Yes,
fine.
okay.
Okay, so 2021, we had out of
So
the,
wait, where are we back out here?
we're gonna do white, county,
Gotcha,
counties.
okay, don't confuse, there's a lot of papers here. Okay.
Let's
I'm on
move
track.
this.
Rich made us go off track, we went from the binder to the paper, now we're back, now you had another question.
Navigate well.
But I'm here, I'm ready now, I'm not afraid to question if I'm lost. Okay.
So we do the Pennsylvania County Pension Plan Report. And it's interesting, we do this for all the counties, even counties that are not our clients, and service. So you look at page 1. We had 62 eligible Pennsylvania counties, 52 participated. It's a little bit lower last year, it just could be, we still weren't back at conferences where everybody would go sign off and getting all their data and everything there. So 84% precipitation. So what we do is we look at your actuary assumed rate of return, your salary increase assumptions, mortality assumption, funding method, and asset value method. So in evaluating a pension fund, and then we look at the current funded level of the plan, we look at the ADC, whether a county's contributions are covering benefit payments in the economic environment in your county. So all these factors when you look at your pension plan, and then it's nice to see where you are versus where other counties are. So let's go to page 4 and look at the defined benefit plan. As you know, it's county contributions, investment earnings go in, and then what goes out are expenses and benefits. And we really try to control those expenses. That's a big thing. And it's also being able to contribute. There's a lot of counties that are still not being able to contribute their full 100% ABC, which you have been doing. And then the cash balance plan is county contributions from employee, county, and then your investment earnings. So on page 5, you can see your county class, your FIP, and you will be in orange throughout. So let me turn this. So we look at the ADC. In 2008, the average ADC for a county in 19 counties was 1.9. Following the 2008 stock market crash, the average ADC in 2009 jumped 119% to 4.1 million. So we really had seen a struggle back then. Even though equity markets rebounded strongly since 2009, average county ADCs continued to increase through 2012. This is due to the smoothing effect of 2008. In 2021, the average ADC of 19 continuous reporting counties is approximately unchanged since 2013, so that basically it's stayed regulated. So when we do this report, we like to compare apples to apples. So we take those counties, what we said 19 that have completely been part of this, and that's where we look, and then we compare you to that there. Actual rate of return, remember you did lower that on page 7. You're right where a lot of counties are at 7%. So in 2008, all reporting counties were using 7.5. 35 of 52, about 2/3 are now using an assumed rate of return less than 7.5. The average rate of return is 7.26, down from last year's to 7.31. So we have started to see some counties, and some of my county clients have lowered it a little bit. 7% is great. The actuary will always come in and say, lower it, but we know that that has a huge financial burden. So depending on where you are, you're right there with all the other counties. We're on page 8. So we look at salary increase assumptions, and you see you're at 3.5. It is used to project future salaries and therefore is part of the county's actuarial accrued liability calculation. Historically, counties use 4.5 for their salary increase assumptions due to the low inflationary environment. You can see that it's gone down. The average salary increase assumption across participating counties is at 3.9. We have seen inflation is going to go up, so that's probably going to be something that you will be looking at in the next couple of years. But you're right there with most of the counties doing that. You changed the mortality assumption, so you're using what every county is doing. You were, I think, at the RP 2000, and then you switched over. 4 years? 3 years ago. On that, this year, 75% of counties are now using the SOA mortality table. If you turn the page, you can see cost of living adjustment. 6 of the 52 participating counties actually granted a COLA for the year 2021. That was not this year going forward. It was last year when it was 1%. We know that you have to revisit that once every 3 years, and you can't just give a portion, you have to give the whole thing, so whatever it is.
To clarify, the 46 did not?
46 did not.
Just wanted to.
It's a hard thing. Some did, and sometimes when you look at it, it doesn't look like it's a lot of money. A couple years ago, I had one county and it was going to add 400,000 on. But if you're not doing the ADC, you're looking at some huge market turns. That actually, even though it looks like a small number, can be a very large number compounding. And I know that, as a board, I see it all the time. You do struggle because, you do want to offer a good wage and cost of living and everything else like that for your pensioners, but it's a tough thing to do in a hard economy.
The other thing I'll note just as it relates to COLAs is if you can see on the chart that you have below, 2021 cost of living adjustment, since 2000, the 2008 downturn, the number of counties that have awarded COLAs, you're starting to dip into the single digits percentage wise of counties that award year over year. So I do want to make note of that fact.
Now, there is also the way the COLAs are calculated, it's been revised. There's no longer a requirement to calculate the COLA adjustment back to the time of the person's retirement. So it is going forward if you ever want to look at that. Asset valuation method, you can see most counties are doing the W. In recent years, we've seen most counties move away from Act 44 towards the more nationally accepted actual 5-year smoothing method, which adjusts the unrecognized gains and losses, the so-called W method. So you can see there, 96% are using that method. And then we go to performance history, and we look at where you are. We look at number of counties. You've done between that 9 and 10 5-year return. you're with the majority of counties there. Now, you could say, okay, we're the third down there, but that is because you also have some very large counties that were diversified, smaller counties that weren't, might have been really heavy in equities that really bumped that up. But we, you're right there with the majority of counties. Look at the 10-year number of counties did 8 to 9% annualized.
Just again, I want to note here, our assumption that we make when we calculate, the county contribution to retirement fund is that we'll do 7%. Is that accurate?
Correct.
So in other words, we're beating that over both the 5-year and the 10-year period, which is indicative of the conservative nature of this board and the fund management. Wanted to note that too.
And then we turn the page, and this is where you wanted to see how you did. We look at 2020 returns. You did between 9 and 12%. That was the majority of the counties there. Remember in 2020, with that first quarter, once COVID did hit and the market went, there was no way. I mean, it was just one of those off quarters that we had as a company, as all the plans. And it was a very volatile time. And that's when I said, if you own the 5 stocks, great. If you didn't own those 5 stocks, you were really struggling. And being diversified, look at last year, you did very, very well. So it was just one of those, when you see it, and most counties did struggle in 2020, but you still had a positive return. 2018, you can see that you were right above most counties. You actually outperformed. 2016, you can see you were right on there. And then you can see in 2017, you were actually ahead. In 2015, and this was nice, is that you were actually positive in a negative year in 2015. So that's what I put you ahead there. Are there any questions? Okay, so you can look at your adjusted funded ratio. You can see on page 17, the mean is 91.9%, and we know that you were, funded there.
Do we know exactly what our number is?
We're at,
Not doing the report yet.
you were fully funded, and then it went down a tiny bit, and then it went back up.
2 or something was the last one, but that was for 2020.
2021, I would assume it's gonna be right there too, on that. So you've actually,
David, forgive me, did you say 102 or 100.2?
102,
102, thank you, David.
and then if you turn to page 18, you see your benefit class. 1/70th, and you can see, you're actually right there, with about 13 counties along your side are in that benefit class. And then page 19, you can see the investment consultants, you actually Marquette, and you can see that we actually have a lot of the counties in the state of Pennsylvania. And then actuarial firm is Born Ferry, which most counties use there.
Before you turn that page, and I'm trying to think, you would remember, Rich would remember. I think this predates the rest of you, but when we did enter into the agreement with Marquette, the other applicant at the time was in fact Cornerstone. Do you remember that? Yes. Yeah. And were they the only two? That seems to be my recollection.
I remember the meetings, I think
They were the only
so.
two. Okay, thank you.
And then your incumbent, wasn't they part of that process?
I'm sorry? No, they weren't. They were getting out of the
They were,
business.
that's why.
Yeah. They left that area of investing. Yes.
So if you turn the page, you can see, page 20, you can see custodians for at US Bank. We actually, when we switched, with US Bank, you're doing very well on cost there. PNC's got a lot. Bank of New York Mellon, we've actually just, moved most of our clients away from there because of all the trading. They can't settle trade same day. So we went with US Bank when we did custody. That's always your choice. If you ever have somebody you want us to look at, that's fine, we're happy to do that. And then you can see number of counties, active participants, percentage 50 to 55. You can see retired participants, the percentage of funds 40 to 45 are right there. So you're actually right where most counties are. And then terminating vested participants. So you really, if you look at your county, you're looking like most counties in the state of Pennsylvania with how your funding is, and your plan participants. And that is it. Are there any questions on this? I always think this is a useful tool just to see where you are. And, you know, gives you, you know, what other counties are doing.
Any questions?
Normally, one or two of our friends from the print media are here, and normally you provide them with copies. You brought extras. Would you be kind enough maybe to leave them with Vanessa?
Oh, well.
If Debbie or Nick or both would want them?
I
I
think
assume
I'll
that's
do this.
okay with the rest of the group.
If it's okay, I'll leave the fourth quarter report. I think that's got a nice year, looks at it. I think just to do a month.
Right.
Is there, and then
Agreed.
the Pennsylvania County Pension Plan, that's actually proprietary, so we'll just kind of,
Okay.
I mean, if you'd like us to share that, we can. But I think this is a good fourth quarter.
Yeah, that tells them what they need to know about the condition of the fund.
Sure. Agreed.
And do we want to set meeting dates?
Did
we?
Yeah, I sent them to you.
Did you?
That's
That's
okay.
right.
I'll reset them.
No, I got it, I know, it's,
It's okay.
I have so many, there's some meetings, I just went to the last 3 meetings, I did, they're all setting meeting dates.
We did, we left them on
We did it.
Tuesdays.
That's
So
right, yes, perfect.
Forest County's not one of your clients, are they? Okay. I'll fill you in after the meeting.
Any other questions, comments, concerns?
Thank you, it's always nice to see.
Thank you.
Absolutely, thank you so
I really
much.
appreciate it, I really appreciate the business, and it's nice working with all of you, so you're so good,
Same
2022.
Yes.
Any new business to be brought before the board? Nothing on the agenda. Is there anything anyone wishes to bring for your business? Any public comments?
Not enough.
I'm sure. All right, with that, we will adjourn the Lawrence County Retirement Board meeting. We'll be back in, usually May.
Okay. Very good. Thank you.
Morgan's got to
Excellent.
turn the computer off.
Thank you.
In your travels, at all the different conferences, I don't know if you've met Basil Hoffman. He's a Forest